Well, we'll go ahead and get started. Welcome all, and thank you for making time in your schedule to join the team at United Church Funds for our quarterly Town Hall Market Update call. My name is Matt Wagner. I serve as the Vice President of Institutional Relationships at United Church Funds, and I'll be joined on today's call by my valued colleagues, Matthew Ilian, the Director of Responsible Investing, and Stacy Pettis, our Executive of Institutional Relationships. We'll be joined later in the call by our investment team. Dave Clausen and Manothi Dhanaraj will be with us today to talk about market performance and some forward-looking slides and information that we have for you. And before we dive in, I want to thank our marketing and communications team, Debbie Weibowo and Adam Sank, for their work, not only with the materials that you see before you, but in the promotion and communication of this meeting. We're greatly appreciative of your time and expertise and what you do for our clients. We have a lot of good news to share tonight, big agenda. And if we want to slide to the next slide, thank you. We have a lot of news to share and a lot of ground to cover tonight, not only on performance, but about how your investment dollars are making a real impact and making the world a better and more just place. And we're looking forward to, over the next 45 minutes, sharing a lot of that information with you. You're going to learn about how we've partnered with others to forward the efforts of social justice, racial equity, and climate justice. We look forward to sharing many of those things with you, as well as talking, of course, about the performance of our funds and how we've been able to move the ball forward to support your mission and ministry. I want to remind you that this is being recorded, and a link to those that registered of the recording will be sent after the town hall. And I would encourage you to forward that link to other members of your investment committee or your church that would be interested in learning more about what we're doing at United Church Funds on behalf of the 1,100 clients that entrust us with their endowments. So with all that said, it looks like we have a great group together. Let's go ahead and get started. We want to move to the next slide. We're going to start everyone tonight with a poll question. And I'll ask Debbie to open the poll. So the question is this: does your investment or endowment committee plan on continuing to meet virtually or in person for the foreseeable future? You can choose virtual only, in person only, virtual, in person, hybrid, or not sure. For those of you that put not sure, that probably means that you don't attend the meeting. So we'll know who those folks are. But go ahead and take some time and go through that poll. We're going to take just a few seconds here and let everyone jump in and give their response. And the reason that we're asking this question, of course, is that it helps our team plan for future meetings, and whether we need to be booking flights or buying more ring lights for our Zoom meetings, if they're going to be virtual. We certainly hope that the time comes soon where we're able to go out and join you all again. Looks like we've got the responses in. About half are going to be hybrid. Very few, about 7% in person only. Virtually only about a quarter, and a few that have still not made up their minds. So I want to thank everybody for participating in that poll. That's helpful to us, and thank you for providing those responses. I'd now like to introduce my colleague on the institutional relationships team, Stacy Pettis. She's going to bring us a few important updates from United Church Funds. Stacy?
Thank you, Matt, and thank you all for joining us. Many of you are very familiar with our organization, but we always like to highlight the foundation in which we exist on. And so some of our key differentiators as a nonprofit investment organization. So a top priority of our responsible investment options are to align portfolios with progressive Christian values. Environmental, social, and governance issues are a top priority for United Church Funds. And we take this opportunity to share about the ways in which your investments are creating a just world for all. In flipping to the next slide, I'm pleased to share some of the organizational updates for the fourth quarter and going into 2022. Many of you may recall that in 2021, expense ratios were reduced either 5 or 6 basis points, depending on which fund you were invested in. For 2022, we have lowered the fees again, and this year it will be by 1 additional basis point. Over the past 6 months, Many of you who were invested in our conservative or aggressive balance fund have received a lot of information from us regarding the elimination of those two funds. As of November 30th, 2021, we no longer offer those funds, and they are in the process of being closed. So if your church is still currently invested, has not sent us your new allocation instructions, we need you to contact us as soon as possible, as those funds are closing. As a reminder, we have initiated a custodial relationship with Coinbase, which allows UCF to accept various cryptocurrencies by donors. So if you're aware of donors looking to give to your church or organization, we are happy to facilitate that process for you. Please contact us if you have any questions on what that process looks like. And then finally, we are now accepting applications through March 1st for Brown Endowment Scholarships, pastoral support, and grants for 2022-2023 academic school year. UCF manages this endowment and has for several years, and we award about $300,000 annually. So time is slowly running out to apply. With that said, I'm going to hand it back over to, actually, I get the opportunity to introduce you to our Director of Responsible Investing, Matthew Ilian.
Thank you, Stacy, and greetings to you all. It's great to be with you. The responsible investing work that we do is part of who we are. Our vision is investment that creates a just world for all. And really, this relies on the conviction that we have to imagine money in service to mission. And often, too often, maybe in this world, those things get flipped. But here at UCF, it's who we are, it's what we do. I want to start off by sharing with you that I recently wrote a blog post in response to a number of columnists, major publications that have come out either attacking or in support of sustainable investing. And so you can go to our website if you want to read the full post, but just to share a few quick highlights from my observations of this debate. This first article was a series of articles. It was a Wall Street journalist came out with an entire series attacking sustainable investing. And I'm not going to go into line by line. A lot of these attacks are old. They've been around for a while. So I'm not going to debate them now, but I do want to draw your attention to the last critique of sustainable investing that we wrote down here, which is attempting to change corporate practice through sustainable investing is a distraction from the simpler and often more effective approach of maximizing social utility through the government's powers of taxation and regulation. Essentially, the columnist is arguing that private investors, private interests should stay out of social interests and government action, that those two should be separate, and that there is a wall that divides the two. And I name this because this is, I believe, at the crux of a lot of the challenges that we meet in our society today. It's a form of intellectual dualism to say that, private interests are over here, social interests are over there. It's a divide of the head and the heart. And we intrinsically believe this is not healthy, that this caused great trauma in our society when we kind of think separate from our from our social action, our private action. And I'm proud to stand with an organization that for its entire history and behind a church that has said that social, environmental issues are fundamentally part of every financial decision that we make. So that's the one point I wanted to clarify, and you can go and read the blog post if you want to dive deeper. In response, in the next slide, Morningstar, a journalist there, came out with a retort, and John Hale is a longtime kind of sustainable investment supporter, columnist. This point number 2, I like a lot. He said, investors can invest sustainably and promote social good environmental policy at the same time. He calls it the walk and chew gum approach. So no reason investors, no reason private interests can't also walk and chew gum at the same time. His last point is around shareholder engagement, and makes some great points. We would argue, and I argue in the column, that he doesn't go far enough. And in this next slide, we list a number of ways that we believe that social or shareholder engagement, shareholder activism isn't just a nice complement to responsible investing. It's integral to a responsible investing approach. And you'll see in the article that I go through a little bit of a flashback historical to the 1980s, when the anti-apartheid movement was pressuring the South African government. And it took financial interests, it took investors, it took college endowments, churches to stand up and say, this isn't right, we're going to pull our money out. And that was integral to the government action that eventually took place. So it was a melding of the two. And this melding of interests, private and social interests, continues to today. We see that particularly in the environmental action. We see it in the racial justice work that we're doing. Fundamentally, these groups that we join, ICCR is a coalition of faith-based and values-based investors, Climate Action 100, coalition of pensions, endowments, and other investors advocating for reducing carbon emissions across the industry. Fundamentally, it's about social justice, private interests being melded. It's the business case for why these things need to change. So that's who we are. I want to go to the next slide and share with you some of the current actions that we're taking, particularly around, this slide is around filing shareholder resolutions. So as owners, we are able to bring issues before all shareholders to vote on. And we do this through the action of filing a shareholder resolution. And you can see we filed 3 on the left. We were the lead filers at Gilead, Meta, and Dollar Tree. And then the 4 other resolutions at UPS, JP Morgan, NVIDIA, and Chevron, we were co-filers, meaning one of our colleagues or partners filed the resolution, and we believed in it so strongly, and they invited us to co-file with them and participate on that. So now these issues will go before investors, and March and April tends to be the season where the general meetings of shareholders happen, and so you'll start hearing from us reports on how these votes take place. I do want to just highlight 2 quickly. Meta, that is the new corporate name for Facebook. And so the resolution that we filed at Meta is that they would transparently report on all of their lobbying. Currently, we know that Meta or Facebook is they have the largest purse when it comes to lobbying of any of the IT companies. But they don't disclose, as well as many other companies, where all of those payments are going. So what we've asked for is that they would divulge all the membership organizations that they're a part of, all of the nonprofits that they donate to, essentially, letting us, that gives us insight into how they're trying to impact policy, government policy. And we believe this is absolutely critical at a company like Meta because of the reputational risks that they have. We all know that data privacy is important, that misinformation on their platform is vitally important. And so we've asked the company through this resolution to divulge all of that information. I also want to draw your attention to the Dollar Tree resolution. This one's different. In this resolution, we're asking the company to report on the company's wages, benefits, and the reference here is that there is this great, they call it the Great Resignation. Many employees, particularly those who are at the bottom of the earnings capacity, have just decided to walk away, or it's not worth the benefits. And Dollar Tree themselves cite these risks in their employer 10Ks in their reports. And so we've asked for them to kind of talk about what strategy that they're taking to support these employees. Now, we've also met with and heard from the employees, many managers at these dollar stores, saying that the conditions are really challenging, that many of them feel like they themselves are at risk. And so as investors, we have the leverage through these resolutions to elevate the issue. And so we were able to meet with the director of HR and with their investor relations on this issue. We'll see how they respond. They've told us that they're going to fight this at the SEC. They don't want this showing up on their on their proxy. We're going to respond to the SEC and tell them we absolutely believe that the investors deserve an opportunity to vote on this issue, but this is in development. So that's just a little bit of how the game is played, and wanted to highlight those two to you. The next slide is a little bit different focus. It's on our how we invest, and in particular, we're highlighting our fixed income fund. We have some very high impact allocations in our fixed income fund, much higher than you'll see in a traditional fixed income fund. And you can see that approximately 42% of the fund is tied to sustainable impact, green bonds, social bonds, pandemic bonds, and then other issues that are tied to UN Sustainable Development Goals. For example, on the social bonds, one of the investments that we made was with the Ford Foundation. The Ford Foundation, in response to the global pandemic, committed to doubling their grants that they were making to social benefit community organizations. And to do that, they raised a $1 billion, or they issued a $1 billion bond. And so by investing in that bond, we put approximately $1 million in that bond. We were helping finance their support for these community institutions. Another interesting financing bond was with the African Development Bank. They issued a $3.1 billion bond, and that was dubbed a pandemic bond that helped finance 900,000 COVID tests. It helped fund 5,000 respirators and over 1,000 healthcare workers across the African, or 12 countries across the African continent. And so this gives you a little bit of example of what do we mean when we are talking about sustainable investing, impact investing, and that's a highlight of our fixed income fund. And so with that, I want to turn to the next slide. We have a question for you. I think another poll question here. So the question is, does your church or organization have a committee or other group that focuses on the following issues? So this is multiple choice. You can please select several options there if they apply. So environmental sustainability, if you have a green team, if you have a racial equity committee at your church or organization, immigrant justice, LGBTQ rights, or other. If you have other, I also want to invite you to, if you want to enter into the chat, what those other are, so we can, be familiar with that. And the last one is we don't have an ESG committee. So we're going to give everyone here just a minute or two to enter those submissions, and we'd love to see what the poll results are. Our hope as an organization is that, that our work is helping build on and supplement the work that's happening in the local churches, in your local ministries. So I see here nearly 40% of you have green teams or environmental justice community, racial equity, immigration justice, LGBTQ rights. So a good spread there. And then that 10% other. So again, if you want to share what social justice committees are out there, you're welcome to do that. But thank you for sharing that. With that, I'm going to turn it back over to my colleague, Matt Wagner.
Matthew, thanks, and can't let you go without thanking you for all the work that you do on behalf of our clients. You know, as you said, I mean, I have this in a note, and we work too closely together, I guess, because I use the exact same word, which is that corporate engagement is integral to what we do as an organization and how we serve our clients related to environmental issues and social issues and governance issues. And thanks for laying that out. And there was a really quick question in the Q&A from our friend Ann in Iowa. Ann, yes, the fixed income fund that Matthew was just noting, with all of the sustainable bonds and all of that exposure, that is the fixed income portion of the moderate balanced fund. The moderate balanced fund is now called the UCF Balanced Fund. We removed the word moderate because of our elimination of the other two funds that use the word aggressive and conservative. Just called the UCF Balanced Fund. And yes, that fixed income exposure is targeted at about 40% of that overall allocation, although I think it's a little underweight at the moment from there. But Matthew, thank you again. Appreciate your presentation and what you do for our clients. We're going to switch gears here, and we see some other answers coming in from the chat. Appreciate that. We'll make sure to log those. We're going to switch gears and talk a little bit about past performance and just walk through a little bit of some of the themes and drivers of performance in 2021. Talk about year-end performance there before we start really focusing on 2022 and beyond. As you can see here, and every time we take a look at the end of a year, there are usually a few drivers that you can take a look at, and we certainly had mixed results towards the end of the year in equities. U.S. equities ended the year strong. International equities perhaps not as strong. But both on an absolute and relative basis, equities were generally speaking up for the year, and in some cases significantly up. We are continuing to watch, and we certainly watched some of these come up in 2021, some of these macro risks. And particularly, of course, we're looking at global aggression on the Ukrainian border, U.S.-China relations, and other things that could disrupt supply chains and certainly disrupt lives and societies. And so as we keep all of those and those conflict areas in prayer, we want to acknowledge that we certainly see that as to some degree a risk to market returns, which is why at United Church Funds, our clients benefit from diversified strategies that really take a long view of markets. And I look forward to being able to discuss that with Dave and Menothi here in just a few minutes. If we could go to the next slide. You'll see index returns from 2021, and then on a 3-year, 5-year, and 10-year annualized basis beyond that. A lot of green numbers on the chart on the left. If you look at the column for 2021, you'll note that the S&P 500 up almost 30% for the year. Tremendous return. The All Country World Index, which is the second line from the top, which would replicate a globally diversified equity strategy, up about 18%. If you look in the middle there, you'll see some red numbers for 2021. Those are bond indexes, the Barclays Global Ag being one we see very often, and U.S. long corporate and treasuries, as well as emerging market debt. And then there at the bottom, you'll see some more green numbers from real estate and commodities for the year. If you look at the chart on the bottom right, you'll notice a significant increase in 2021 in interest rates. If we take a look at the 10-year Treasury, the 10-year Treasury started January of 2021 right in the neighborhood of 1%, ended 2021 at 1.5%, and as of today, just crept over 2%. So a significant increase in interest rates, effectively a double in the 10-year Treasury rate over the course of 13 months. So something that has been a headwind to bond investors and something that we are certainly keeping our eye on at United Church Funds. If we can go to the next slide. The next two slides, we'll just look at just a couple of highlights of performance. These are our managed funds. These are the funds that we pair together to build our fund of funds. And just quickly of note, our domestic core equity fund, which is our U.S. large cap equity fund, for the year, up over 29%, beating its benchmark and its peer group. And another really solid performer for us this year was the global equity fund, the Beyond Fossil Fuels Fund. It returned 22.7% for the year, up over its benchmark by 4.5%, and significantly outpacing its Lipper peer group. The Beyond Fossil Fuels funds, as you'll remember, were started in November of 2014 as a response to the General Synod resolution calling on our denomination to be leaders on climate justice. And we're going to look forward over the course of this year and next, as we lead up to the 10th anniversary of that resolution at the General Synod in 2023. We are going to be sharing a lot of information about ways in which we've implemented client justice strategies into our portfolio on behalf of our investors, and we that's going to be definitely a theme that you see replayed in future town halls. If we go to the next slide, these are our fund of funds. As you can see here, a slimmed down list, because again, that aggressive balanced fund and conservative balanced fund are no longer available. And you'll see there the second one from the top, the UCF Balanced Fund. That is the moderate balanced fund with a new name. No change in strategy, but a change in name. It is our most utilized balanced fund by the most number of clients, and it returned 9.73% for the year. And over the last 5 years, averaged a rate of return of 9.5%. Our Beyond Fossil Fuels Balanced Fund, which is a mirror fund to the UCF Balanced Fund. Both have allocation targets at 60% global equity, 40% fixed income. Our investment team has the ability to underweight or overweight those, plus or minus 10%. The Beyond Fossil Fuels Balanced Fund had a great year, earning about 13.5%, and over the last 5 years, averaging about a return of just over 10% per year. And a fund that's not as utilized by our clients based on restrictions in some of our clients' investment policy statements is our Alternatives Balanced Fund, which implements not only equities and fixed income, but also a sleeve of alternative investments. And that fund also had a terrific 2021, up about 11%, almost a full point above its benchmark. Next slide. Excellent. So with this slide, I'm going to introduce our colleagues on the investment team, Dave Clausen and Minothi Dhanaraj, and also reintroduce my colleague, Stacy Pettis, for the first question for the investment team. Stacy?
Great. Thank you, Matt. So I wanted to talk a bit about this slide, but also pose a few questions for both Dave and Minothi from our investments team. So we're aware that the S&P valuations have been extremely high for the past 2 years, and we're starting to now see them come down, which has been affecting portfolio values for everyone. Can you share with us some of your thoughts around why this is occurring, such as the ending of easy money and the concentration that exists in tech stocks within the S&P 500? And how are you shielding the portfolio against some of this?
Sure. Well, thanks, Stacy. Great questions, and thanks for that recap of a pretty good 2021 for all the funds. In front of you is really a graph of exactly what you're talking about, Stacy, and that would be the valuations on the S&P 500 over the last almost 30 years, from 1996 and beyond. And you can see that the price earnings ratio of the S&P 500 is elevated. Part of the reason why the valuations have come down a little bit is actually because earnings, have really come through, and earnings this year and the projections for next year are still fairly robust. Kind of in addition, we've had a little bit of a sell-off, this year. So yeah, valuations are high. I guess if I drew a real line of sight between this period and the last period, we think that the earnings outlook is a little bit better for the companies. We remember the bubble in the late 90s, fairly well. What we're doing about it really is diversifying the portfolio globally. We do think there is some risk in the S&P 500, primarily because those tech stocks are driven by earnings, but they're also driven by the change in interest rates. And as interest rates go up, the value of that future stream of growth, comes down a little bit. So anyway, to make a long story short, to the extent to which interest rates continue to rise, it could affect the index returns of the S&P 500. And we can talk a little bit more about, kind of strategies when we get into inflation and maybe in the wrap up.
Great. Thank you. Thank you for the initial response to that. And flipping over to the next slide, I think, Matt, if you wanted to share a bit about inflation and pose the next question.
Yeah, sure. And I want to remind our participants that if you have questions, comments, please put those in either the Q&A or in the chat feature. Either one is fine. We're monitoring both. And then after we get through just the next couple of slides, we're going to dedicate some time to Q&A, and we will get the answers to hopefully as many of those questions as we can. So David Menothi, we wanted to include a slide on inflation for this town hall. I think Stacy would probably agree with me that this is maybe the most the topic that we get the most questions on in portfolio reviews. I think often because people can feel this one, right? We feel it at the gas pump, we feel it at the grocery. If you're putting an improvement on your house, the cost of lumber and goods has really gone up. And in 2021, we did talk about this at a couple of the town halls just briefly, and we talked about whether the inflation that we were feeling in 2021 was, whether it was transient, caused by the pandemic and supply chain issues, and it would, sort of work itself out, or whether it was more structural. Economists were split on that. I think is fair. So where do we stand on the issue of inflation, the risks to the portfolio, and then also, are there asset classes or market sectors that we have in the portfolio that perhaps benefit from rising prices and other impacts of inflation?
Sure, I'll take the first part and then maybe turn it over to Menothi in terms of the implementation. We have no crystal ball, but we have some experience. And I've really noticed, particularly in the last couple of days, and even today, the rhetoric around sustained inflation, which we haven't seen in really quite some time, has become a real drumbeat. With recent consumer price index readings, up in the 7.5% level, and then today the producer price index up in the mid to high nines. I always like to frame these questions not in terms of necessarily the worry, but what are the levers really that the United Church Funds has to utilize to protect and insulate against inflation and rise in interest rates? And so I would just lead that off by saying, you will notice, and let me try to make it even more apparent, that where we have the discretion in balance funds to allocate assets toward equities and away from fixed income, we are doing that almost to the maximum degree possible. In the UCF Balance Fund, in the Alternatives Balance Fund, in the Beyond Fossil Fuels Balance Fund, we are underweight to fixed income by about 10% versus the target. So for example, in the UCF Balance Fund, the target for equities is a 60-40 balance mix between equities and fixed income, and we are 65% in equities and about 30% in fixed income, the 10% underweight, and have the remaining 5% in cash. So trying to protect and insulate against rising interest rates caused by this inflation fear. I can talk about the prognosis, for inflation, if people really want to in this conversation, certainly as a topic of conversation. But Menothi, maybe just talk about those sectors of the portfolio managed by active managers in the various parts of the market. So just kind of the headline is that we believe in indexing in some portions of the portfolio to keep costs down, for example, in the US, but by and large, we are hiring managers to navigate inflation and figure out what companies have the ability to raise prices while also at the same time paying a fair wage. So Menothi, maybe give us a little bit more flavor in terms of the managers that UCF hires that can try to be to protect and be a little bit nimble in this environment.
Sure. So, on the last slide, Stacy discussed how are we shielding our portfolio, and part of that is by having active managers. So especially in environments like this, where the market is quite volatile, it's good to have active managers in that can find those companies and those sectors and allocate accordingly based on the volatility in the market. So we do have a diversified group of active managers from domestic to international to emerging markets, and then between value and growth. So in market environments like this, you tend to see a lot of the value managers start to perform better. And as Stacy noted on the last slide, the technology sector has been getting hit a bit more because they're more growth oriented. And so the sectors that you'll see that tend to outperform in these environments include areas like energy and materials and financials that benefit from as rates start to increase.
Thanks, Menothi and Dave. Appreciate that. And yeah, I think it goes back to that theme, even our theme from 2020, where returns were mixed. We have to be able to stay nimble, and our clients really benefit from the diversification as well as the experience. So thank you, Stacy. One more.
Sure. Thank you. So in looking at these charts on economic growth and GDP, we see that GDP took a significant dip in 2020, and we know why. But we also saw the Fed step in with robust fiscal and monetary stimulus, which appears to have us back on track as it relates to the growth trend, although it may be at a slower pace at this point. So as we enter into a more volatile period, as Menothi was sharing, how is your team assessing and interpreting market behavior? What expectations do you have for performance in 2022? So we know there's a lot of tactical tilting that's happening through the managers, but what else are you thinking about, and what are your expectations for 2022, as some of our clients are concerned if they're in the right place, or if they should be thinking of other types of movements? If you could just share with us.
Sure. Well, I think the most difficult part of things is trying to time the market this year, and knowing that most of our clients' money is in long-term endowment monies. I think we've demonstrated the ability to sidestep difficult environments to the degree possible. The baseline real gross domestic product estimates for this year, 2022 and 2020. Well, this year, 2022 and 2023 are in the 5% range, and then slowing down to 3%. With relatively strong earnings, with reasonably rapid growth still, and I would argue still relatively low rates. We believe that the equity markets can still deliver the kind of returns needed to support endowment draws of 5% with a balanced portfolio. But I think that the most operative word, and Matt used it, is nimble. We've been in really except for 2020, but when you look at the last 3 years, clock along at some pretty exceptional returns. And last year was a year where you didn't have much volatility, at all. So the fact that we've got the 5% or so cash, the fact that we're using active managers, as Menothi alluded to, this will be a year where we try to take a little bit more tactical advantage in the context of a still, as I said, constructive outlook for global equities. And then maybe just circling back to that first slide, and just recognizing that the UCF equity portfolios are globally diversified. So there are really some valuation, the more favorable valuation in emerging markets. And as of yesterday, the S&P was down 7% for the year. The NASDAQ 100 was down 12% for the year. And emerging markets equities were actually up for the year. So, the world isn't always in sync. Sometimes it is. And sometimes there's the ability to to stay diversified, which is really a basic tenet of investing, even when it doesn't seem like the right thing to do, which is the last couple of years. So that's kind of the answer in terms of the resilience, and thinking not only about the zigs and zags of the next couple of weeks or couple of months, but how do we think about what asset classes are going to be in favor over the next couple of years? And that's really the competitive advantage of an endowment. Keep your head while others are losing theirs, because we have a longer term time horizon for the endowments. Hopefully that makes some sense, and I'll turn it back over to you folks.
David does. Yeah. Thank you so much for that response, Manothi. Thank you. I think we're going to try to do a little bit of Q&A with the time we have left. So I appreciate everyone putting their questions in the either Q&A or in the chat feature. We're going to try to answer these live as we go through. If I don't have a specific answer on a specific question, I promise you I will get back with you. Doug Smith had a question about and mentioned the UCC's program with retiring medical debt. He mentions that it was worth $33 million to Ohioans. I think there was a news release just out either yesterday or today from the national setting about that. And you're asking if UCF is involved with these decisions. We have been involved with medical relief reduction campaigns in the past. I will just stop way short of taking any credit for that. We believe in that. We believe in those campaigns, and we have certainly participated, and I'll be happy to get you specific numbers on where we've done that and the like. So Doug, I appreciate that question. Carl Lehman has two questions. Number one, what was the return for the equity allocation of the balance fund? And number two, what is the duration of the fixed income fund in the balanced fund? So on the equity side of the UCF balanced fund, we have a fund called the Total Equity Fund, which, as Dave said, is a globally diversified equity fund, benchmarked to the MSCI All Country World Index. Our fund returned just under 17% for 2021. I think it was like 16.9 and change. And over the last 5 years, that fund has returned on average just over 13.5% per year. As it relates to the duration of the fixed income fund and the balanced fund, Dave, you may have a more up-to-date number than I do there. I know we were in the neighborhood of a duration of 6 in the fixed income portfolio. That may have changed because fixed income is moving so rapidly, or rates, I should say, is moving so rapidly.
Yeah, the estimate I would give is about 6, and that's the combination of the managers having a lower duration or interest rate sensitivity versus their benchmarks, and then also that there is an over 10% allocation in those funds to something called bank loans, which basically have no duration at all. They have a quarter of a year duration or interest rate sensitivity. So that does protect the fixed income portion from interest rate changes to some degree, and you'll see an outperformance versus the benchmark as a result. The other way that, Carl, that we're protecting is, as I mentioned, are underweight by about 10% in balanced funds in fixed income to begin with. So I could do the math there in terms of the overall sensitivity of that 40% is far lower than it normally would be. Hopefully helpful, and happy to answer any follow-up questions, Carl. Thank you.
Yeah, thanks, Dave, for that. Adrian Culver has a question. How are you able to lower your administrative fees? Our lower fees at United Church Funds is a function, of a rising tide lifting all boats as it relates to our assets under advisement. So we are a fixed cost organization. We don't charge our clients any commissions or advisory fees beyond the expense ratios, and so we're able to control cost at United Church Funds in ways that are, I think, fairly unique in the wealth management industry. And then number two, the pandemic, just like for many of our clients and churches, has given us opportunities to tighten our belts a little bit. We're not traveling we're not traveling at all at this point, and we certainly traveled a lot ahead of the pandemic. A lot of events and things that we sponsor historically have been postponed or have gone virtual. So in a variety of different ways, we've been able to control cost, and we believe at United Church Funds that we should pass those savings back to our clients in the form of lower expense ratios. Dave and Manothi, perhaps just a quick question on a big topic from James Silliman. What are your thoughts about the extent of Fed interest rate increases for the coming year? Perhaps I know Goldman came out and said maybe 3 or 4 interest rate hikes in 2022. I think Dave mentioned before he does not have a crystal ball, so I'm not going to ask him to prognosticate on that. Menothi, I don't know if your crystal ball's clear or cloudy on this one either, but either one of you, feel free.
Pretty clear it's going to be in the 4 range, and given the recent news, it looks like it might be 50 basis points at the upcoming March meeting. We don't think there'll necessarily be inter-meeting rises, but it will be organized, I think, methodical, and a fairly strong response. But remember, the terminal rate for the discount rate appears to only be in the 2.25% range, and we think they'll generally stop there with the long-term 5 to 10 year inflation expectations really only in the 3% range. So we'll watch it carefully. I think the implied question is whether or not it will be rapid and chaotic. And I think if market interest rates really get out of control, that's the big risk to the market. But I think it will be relatively contained.
Sure. Arthur Clement, I believe our friend from Atlanta, has a question about inflation. What's the thinking about commodities? Is there an increased allocation of commodities in the balanced and global portfolios? Short answer to that, Arthur, is probably not. In fact, two of our best performing funds versus benchmark were our 2 funds that have no or very little anyway energy and commodity exposure in the Beyond Fossil Fuels funds. So we've got about in the equity portfolio of the balanced funds. I think as of the end of the year, we had about a 4.5% allocation to energy and utilities combined. So pretty small energy footprint in our portfolios. We're certainly committed to energy solutions beyond fossil fuels, and so I would doubt that you would see us, for the sake of chasing return, dip our toe more into commodity markets in our overall portfolio. Mel Boynton has a great question about our fund fact sheets. They usually, Mel, you're absolutely correct. They usually do come out sometime between 30 and 45 days after the quarter. It takes us some time to generate that information from a couple of our vendors. We absolutely would like to get you that information into your hands quicker, and certainly has been an internal dialogue that we've had. Ann McCorkadale has a question. The total equity fund has underperformed the benchmark for all periods shown. To what do you attribute that? I would answer just quickly. So the impact of fees over time, certainly. Let's remember that benchmarks are unmanaged and no fee. Also, obviously, we're using active managers, whereas that is a completely passive approach. Dave, anything else that you'd want to maybe add to that? Our performance has certainly been, on a versus the peer groups, perhaps, stands up quite well.
I think that's right. And I also, prospectively, I really look at the ability of active managers to outperform in a much more volatile market. And to be candid, on the equity side, we really have had a terrific run in the small cap area and in the international equity area. And in the domestic large cap, we were hindered by one manager who's been let go. And you heard Matt's comment about the results in the large cap portion of the portfolio ahead of the S&P, even in an up 28% year. So, we're on track, and I would expect that the outperformance would resume, particularly in a choppier market.
Yeah. And there are a lot of reports and a lot of things you can read out there about, sort of the from 2010 to 2020 being sort of the decade of passive investing. And as volatility returns, I think perhaps we can see a return to, well, I think we have. I mean, I think it's clear if you look at active manager performance over the last couple of years, it's clear that those with their eye on the ball are doing quite well. Last question here that we have about current Fed assets. 1 trillion, 4 trillion, 1997 to 2012, then from 4 trillion to 8.5 trillion, closer to 9 trillion now. What are the major concerns with divesting such high levels of current asset. And I don't know if you have any last comments, Dave or Menothi, on the Fed generally, or some of what they could maybe contribute to, or maybe cause some worry amongst investors.
Well, it'll be a bit sequential with the cessation of aggressive Fed buying, the raise in interest rates, and then the potential unwinding of the balance sheet, which obviously merits watching as to the speed. Really, I think is a really operative word, and the extent to which markets get disrupted by speed. But I think the Fed is in fairly steady hands, and it will be organized and liquidated over a period of time.
Excellent. Thank you. Thank you all for your questions, and certainly thank you for participating in this afternoon's call. Of course, we're all at United Church Funds very appreciative of the opportunity to be your trusted investment partner. I want to thank my colleagues, Matthew Illian, Stacy Pettis, Dave Clausen, Menothi Dhanaraj, and Debbie Weibo, and Adam Senk behind the screen, if you will, helping us put on this really important communication opportunity with our clients and partners. I hope that you've learned something over the course of the 45 minutes or so that we've spent together. I know that we always want to be in communication with our clients, and we always ask that you never hesitate to reach out to us with questions, whether it be on your accounts or performance or markets in general. We have a staff of folks who are working full time to make sure that we're servicing your accounts in a manner that we should, and we're certainly appreciative of any questions that you send our way. With that, I want to thank you all again for being part of our call tonight. Have a great night, and thanks again from our team.